Well, property prices are rebounding as the Reserve Bank is tipped to keep interest rates on hold tomorrow.
Let's bring in John Keogh, economics editor of the Australian Financial Review. Good morning, John. 7% inflation, but the RBA is not expected to raise rates.
Yeah, good morning, guys. Look, curious one, this, isn't it? Financial market traders are saying there's a 0% chance of raising rates tomorrow, the RBA, and 3 of the big 4 bank economists say they won't raise rates. Only Commonwealth Bank holding out, saying there could still be a rate rise. This is mind-boggling for me. I do think the Reserve Bank will probably keep rates on hold tomorrow, but there's got to be a better than 0% chance they increase. I mean, the Shadow Treasurer Angus Taylor is putting around figures this morning showing that our underlying inflation rate's higher than the US, the UK, EU, Canada, and some of those foreign central banks are still raising interest rates. I think the RBA wants to take more time just to assess the impact of the previous rate hikes, but, you know, there's still a small possibility that they could hike rates tomorrow.
Property prices on the rise again. Does that help?
Yeah, well, it's interesting because since the RBA's pause, the property market's getting a lot more momentum. So we saw CoreLogic put out new figures to the end of April, finishing yesterday, showing for the second month in a row, national house prices have risen. They've gone up for 3 months in a row in Sydney, and that's after they fell about 10% since the RBA started raising rates. They've made up about 1% ground since then. So the short, sharp downturn is over, according to CoreLogic, and we're now into recovery mode.
All right, well, how did auctions perform over the weekend?
Better than the Bombers.
Yeah, pretty
Oh, Carl.
Yeah, better than the Bombers. They're pretty solid auction results over the weekend. About 7 in 10 homes sold nationally. You could see there, Melbourne had a really outstanding weekend, 78% of homes. Perth and Brisbane, their recovery mode's happening a bit slower. But across the board, pretty solid auction results across the country there.
Still not a lot of supply. Good on you, Johnny. Thank you so much, man.
Welcome back. Well, it is a big week in the finance world. New property prices come out today, and tomorrow the RBA decides if it should take its foot off the cash rate brake.
But ahead of the RBA's decision, plenty of lenders are already cutting fixed rates. Money expert Effie Zahos has drawn a bead on them for you at home this morning. Tell us about today's new data, Effie.
Good morning. Yeah, it is a big week. We've also got retail sales as well coming out. RBA will be looking at all of this, but property data this morning shows from CoreLogic that maybe the downturn, it's the end of it. We've reached the bottom. What they're showing is it's the second consecutive jump in prices. This is the latest data from CoreLogic out this morning. Sydney is leading the charge, up 1.3%. So to put that in perspective, if you had bought a house in the beginning of January, it would be up $23,000 a house price in Sydney. Perth would be the other one showing a positive one over the past 4 months. And look, a lot of that's got to do also short supply, migration coming through, and the rental crisis they're opting to buy.
Yeah, OK, there you go. Well, the RBA rate is today... Where? Let's start that again. Tomorrow.
Yes,
Not today. RBA day tomorrow.
They're probably talking about it for sure.
Yeah, for sure. What are we expecting?
Look, what surprises me, Sarah, is that the market is saying 100% no way our rate's going to move. I find that really interesting. Most economists are also saying probably not. CBA, which has probably picked it pretty sharply, says that they may move. But just to let you know, the cheapest fixed rates, even if the RBA, whatever happens, 32 lenders to date have dropped their fixed rates. On Friday, we saw NAB drop its fixed rates by as much as 0.6%. That was for investors, 0.5% for homeowners. These are the cheapest rates on the market right now. You can see there in that little yellow strip down the bottom, if the average variable rate is 6.14, you can see there's no premium to lock in.
So what about variables then?
OK, so variable at the moment, you're looking at 6.14. The question for people would be, would I be game enough to lock in knowing that some banks, like the Commonwealth Bank, is even saying rate cuts by the end of this year? So I've done some analysis here just to show you. The lowest 3-year fixed rate in the market is 4.99. The lowest variable is 4.94. If you're on the average rate of 6.14, this is how much interest you'll pay over a 3-year period, assuming the forecast for the Commonwealth Bank are correct. You can see here a no-brainer. The cheapest rate on the market is going to get you the best deal, but if rates move, will it stay there? There is some merit in locking in, and you could actually get some relief, but it's really up to the homeowner to make their own decision.
That's a hell of a difference.
It is, Carl, because that's the cheapest in the market, 4.99. Like I was saying, most homeowners are probably paying around 6%. So you're probably thinking, oh, OK, there's probably maybe one more rate hike. Should I lock in and get some relief? Here's some analysis to show you what you would pay over a 3-year period, assuming even the forecasts of rate cuts.
What you've got the last couple right, unusually. What do you think is going to happen tomorrow?
Oh, it's a hard call, Carl. It really is.
Because inflation's not coming down.
Inflation is
slowly, but
yeah, no, you're right. And when you look how we compare to other countries, it's still quite high. But the RBA, even if it increases interest rates tomorrow, it's not going to do anything to do with service inflation, and that's where the numbers really got up. Energy, fuel, or not fuel, sorry. So mostly energy, anything to do with service. Increasing interest rates is not going to cut that. But what we've got, unemployment still not that level that they want it. I think I'm going to make a call here, and you're going to get me tomorrow, but I think they may move it. If not, can I have a little caveat?
Yeah.
That they probably will wait to see the next monthly inflation data and see what's happening there. Another one.
Tracking further.
Yeah.
Good on you, Effie. We're on the record. It's 8 o'clock.
Sure am.
Well, the cost of building new homes is about to get even more expensive, with changes to the National Construction Code starting today, expected to cause more pain for the industry. But it's hoped the new changes will boost the quality of new dwellings. Association of Professional Builders co-founder Russ Stevens joins us now on the Gold Coast. Russ, good morning. Thanks for your time today. Now, customers are set to bear the brunt of these changes. How much more can they expect to pay?
Yes, good morning, Sarah. Well, with the cost of construction going up, the consumers will ultimately pay that price and have to cover that cost, which we expect to be around about 15% by the time all these changes are fully rolled out towards the end of the year. However, I think it's important to realise that Australia does need to keep up with international standards, so this is a never-ending improvement of the construction industry.
I guess the issue, though, Russ, is that the prices have been going up for so long, so an additional 15% is going to be really difficult for a lot of customers. I guess builders too are suffering.
Yeah, that's right. What we've seen over the last couple of years is 20% year on year for the cost of construction. Another 15% on top of that. What that equates to is about a 65% increase compounded in less than 3 years. So that is going to obviously be a large cost to cover. And when you combine that with reduced ability to borrow money for consumers because of the increase in interest rates, then it probably will lead to a softening in demand for the construction of new homes.
But that's a massive problem, obviously, and I just can't see how people are going to be able to afford this. If it is the 65% you suggest there, compounding over 3 years, I mean, that's astronomical. Families simply can't afford that.
It's a hell of a lot of money to find. It's a lot of money to borrow at the increased rates, yes.
What does that mean for the industry generally then?
Well, I think what we'll continue to see, just like we've seen over the last couple of years, the best operators in the industry will adapt. They'll adapt very quickly and they will thrive. And then the less good operators are going to fall by the wayside, as we've seen over the last couple of years as well.
Yeah, I wonder what that actually looks like, though, when we talk about some finding success and others not. What are the positive, I guess, impacts of these changes, if there are any?
Yeah, there are plenty of positives here. I mean, what we're ending up with are safer homes. They're going to be more sustainable and more environmentally friendly. So they're going to be kinder to the environment as well. So we're getting a far better, higher quality product. And it's no different to the car industry. Every few years we see increases in requirements there and we end up with a better quality product. And it's exactly the same within the residential construction industry. We're going to see better quality homes.
Yeah, we've been inching towards a more sustainable model in recent times. All right, Russ, thanks so much for your time. Appreciate it. Hey there, Today fans. Sarah and...
What's my name again?
Oh my God. Carl.
Hey, thanks for watching our YouTube channel, though. Subscribe now for more news, special reports and amazing Aussie stories.
And Carl misbehaving,
Whoa,
of course.
that never happens.
Always happens.
What's she talking about?
Always happens.